Leaked memo says that UBS was 100% closing out all of their silver positions. By their internal memo says silver will be between $300 and $500, depending upon how orderly or disorderly it gets. That JP Morgan has told all of their traders to exit all futures positions by the end of January, all of them. And that same thing happened with Morgan Stanley. All leaked memos that made it to the traders. In just the first few days of the month, we've seen pretty damn well near 35 million ounces of silver delivered. 35 million in a non-delivery month within a week of trading. You add that to what we already saw delivered in December, and you're over 100 million ounces of silver that's been delivered. All of these other assets have been allowed to move higher in this inflationary world that we live in, making the people who hold assets wealthy. Why did they hold down gold and silver? And okay, they did. So now where does it go when it's no longer being held down? That's the big question. I would argue much higher with volatility, but much higher nonetheless, until we see a massive influx in gold and silver, additional supply. The Fed has lost independence, gold will go parabolic. And I think the Fed has lost independence. I think what you are looking at is further incentive for nations around the world to continue to dump treasuries and dollars. Who wants to hold dollars or accept dollars for goods and services when we are moving at breakneck speed into a devaluation of the dollar and to more suppression of interest rates? Any folks who are holding dollars, you're silly to do it. Its value is akin to a melting ice cube, and this will just make it worse. U.S. banks are largely net long. And as their rivals are drowning in losses, then the U.S. banks are largely net long. They did the jiu-jitsu move and they flipped. Who's short? The European banks. Trump believes, according to Luongo, that they're involved in the election interference perception of anyway. They got all these banks hanging on by a thread with massive exposed naked shorts on the LBMA. David Jensen will tell you 2 billion ounces of outstanding contracts could stand for delivery against 140 million ounce float, which he would say stands to question. That he doesn't even think there's that much, even though they're publicly saying there is. But even if there is, that's a rehypothecation by 15, 16 times. 1 out of 15 gets the metal, the rest, and that's systemic nature. If a bank like UBS fails, well, they don't just own metals, they own everything, from equities to Forex to you name it. And the systemic contagion blows up the entire ecosystem. Or you've already paid the money, and what if the price collapses by 50 bucks an ounce down to 30 bucks? You're out of business. You just lost, millions and millions and millions of dollars. You might as well shut down operations. So they hedge their inventory that they are working to sell. But because it takes several weeks, they're not selling it. They're not rotating their cash fast enough. And a mint box of Silver Eagles weighs 42 pounds. What does 65 million ounces weigh? And who's doing it? But this is every single month. I've been screaming this every single month since a year ago, November. That's the largest December influx in the history of the COMEX market, which goes back to 1974.
U.S. banks executed a secret jiu-jitsu move, flipping net long on silver as European banks drown in short losses. This coincides with catastrophic COMEX deliveries, a record December followed by 35 million ounces, seized in January's first week, proving a physical metal war has begun. The Fed, losing independence to political pressure, accelerates a global dollar exodus.
The risk isn't in silver going from 80 to 70 or gold going from 4,600 to 400. The risk is waking up in a market, and you've seen this yourself since you and I have been working together, where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to buy it is gone. Silver time bomb, where non-U.S. banks are net short 206 million ounces or 33% of open interest. And these unrealized losses are biblical in scale, done again. And what the Financial Times article says and what the bank participation report largely corroborates. So what's happened to their short position as the price moves up by $6? Bang, margin call. Bang, margin call. Bang, margin call. And they're getting margin called to death. And so they're like, oh my God, if we don't put up this money, they're going to close us out. They're going to liquidate our positions. We're dead. We can't take any more business. We can't take any more business until we clean out this whole supply chain thing. We got stuff in works, yeah, but it's taking too long. And so what's happening is many of the refiners stopped taking new orders for the last several months until they clean up their, what they already have in production. And as a result, the big primary distributors or anyone making a market and the stuff was paying under spot for it. And I bought every single penny I could buy, literally, because I saw that very clearly. Now this will change, but it's really because the refiners are getting margin called with their exposure. One of the most important tells in my mind right now is the Shanghai market consistently pricing metals above Western spot and futures. And it's basically screaming that the metal's worth far more than where it's being financially priced here in the West. And I think that's a big deal. This widening spread is a signal of tightness. It's not a rounding error. It's perhaps the beginning of real price discovery for the very first time. I guess I would say it like this: the East is doing price discovery in the physical market, and the West is still doing it price discovery in the paper market. But this spread, which continues to widen both in lease rates, which were as high as 30 or 40%, you can lease metal for short periods of time to cover, whatever it is, to borrow it and sell it or sell short, or to cover the need for it or whatever. You can do that. Those premiums are usually a fraction of 1%. They've been as high as 40%. They're about 8 or 9% right now. That's massively higher than what it normally is. And it disincentivizes leasing, makes it really hard to cover a position when you got to pay 8, 9, 10, 30% to borrow the silver.
Meanwhile, Shanghai's physical price massively outpaces Western paper prices, exposing the supply squeeze. A leaked UBS memo warns of banks exiting all futures positions, with internal silver targets of $300 to $500. The dam is breaking. When physical demand finally shatters decades of paper suppression, the move will be violent, disorderly, and parabolic.
In terms of silver, people need to understand it's a tiny market relative to the capital that can and is flooding into it. And when that happens, the move will be fast, as we're seeing, and disorderly, perhaps, as we will really see. And when this spread widens, when these two worlds stop agreeing, that's when the physical market begins to overrule the paper market, and that's when the dam breaks. And I would argue the move won't be polite. And that's the proper way to look at it, right? And not be so bullish that you don't see some pitfalls, but be bullish enough to hang on when you get bumped. And because the bull wants to throw you off at every chance, that's for sure. And I was watching these junk premiums collapse, and I literally told both operations in Florida and in North Dakota, go into every line of credit you have, and I will provide whatever amount of money that I have as well, and buy up every single ounce you can find in pre-65 silver. I don't care. Turn over every rock, listen to everyone who's calling you, and buy it. And that's the truth. And why? Why did it get so cheap that I could buy it at, as much as $2 under spot at one point? Why? Or even lower. Why did that happen? Because here's how it happens. So that overhang will end quickly, and you'll see premium slingshot on it and catch up. And the reason that happened in my mind is that, so you have half a dozen companies like mine who got this, right? Maybe, us and Money Metals and APMEX and JM, whatever, they figured this out. And so they went and bought everything. But what did they figure out, and how did they figure it out? If rates don't go lower, well, and easy money doesn't continue, you end up having the whole system crush under its own weight. You pull out all of the money that the Bank of Japan now is forced to retreat from, in terms of all the money that they've had spread throughout the global ecosystem because of low interest rates in Japan. Again, when the market suppresses interest rates or when the banks, handful of rich bankers, suppress interest rates, instead of letting the market do it, you create distortions. Japan is going to have to deal with it. We're going to have to deal with it. And after decades of yield curve control in Japan, and that now bringing their assets and the money back home to buy Japanese government bonds, creating a domestic bid to replace maybe the waning influence of the Bank of Japan. Well, the same thing is true here. They're going to have to deal with it. We're going to have to deal with it. And I think that that's what Trump understands, that higher rates will blow up everything. Stocks, bonds, real estate, the insurance companies that are loaded with treasuries, the banks. We saw what happened when the 10-year went above 5%. What happened? What if it went to 10%? And in an environment where the world is selling treasuries, he wants to do this. But it's interesting because the Genius Act will create synthetic demand for the front end of the curve. That is the end of the curve that supposedly that the Federal Reserve has the ability to control, the very, very short overnight lending market. And I know you remember that. And I was saying it to you back then that something is breaking in the system, that delivery is being prioritized over paper promises. And then we moved to, well, why are all the central banks repatriating their gold from the Bank of England and the New York Fed, which gave Western rule of law and access to the COMEX and the LBMA? Right? Why are they doing this? So we've seen purchasing by the central banks. We've seen repatriation by the central banks. And let's take it one giant step further. Who the hell is doing it here in the United States? And when you talk to guys like David Jensen who tell you that the LBMA is about this close to literally blowing apart, when you listen to Tom Luongo, who says Trump is out to get the European aristocrats by blowing up maybe the banks, how do you do that? Well, you fool them into thinking it's tariffs. Everyone sends the metal back here to cover the tariffs because the banks in the United States and Europe have gone back and forth, sending metal back and forth, largely in the form of warrants. In short, I think it can very quickly cascade on down into the retail market. Now, it's starting to get a little bit, it's bubbling in the retail market. It isn't where I think it needs to be. It's not frothy at all. But what you see at the highest level of huge deliveries that are as unusual as a 10-leaf clover, let alone a 4-leaf, I think it will start to trickle down into the retail market where availability becomes very difficult because we're seeing it at the highest level. And at that highest level, those institutional sized bars, well, those are the ones that find their way into refineries that make coins and smaller investable bars. So yeah, it's coming, but not here yet. But it is coming, and you can see it through deliveries that are so far outside the realm of normal that the fact that guys like Jim Cramer and any of the Main Street analysts who supposedly care about the public, the lack of any journalistic integrity is appalling to me. This to me is a much, much more interesting story than the crap that they talk about every day. And yet there's not even a word that silver's at all-time highs unless it's, Reuters calling it the devil's metal and stuff. So yeah, it's just appalling to me. The long end of the curve, you're talking the 10-year Treasury is the primary instrument by which mortgages and credit cards are written off of, and lease rates and all that. They all come off the 10-year. Well, who wants to give, our money, or who wants to give us money for 10 years at rates that are so absurdly low? I mean, if rates were to normalize to a level that was commensurate for money creation and inflation, this is why they suppress the measurements of inflation. That's why they lie about the CPI. And because if it were true, if we really understood that inflation is closer to 10 or 11%, as John Williams would say, instead of the 3 that we're being told or less, no one would buy things like 10-year treasuries to guarantee a negative real return. So in order for the 10-year Treasury to find demand, either rates have to go much higher or, as Judy Shelton says, peg it to gold. Now, if you peg the back end of the Treasury market to gold in an effort to continue to allow the dollar to devalue by letting gold go higher and higher and higher and higher and letting the dollar go lower and lower and lower and lower, then you don't need interest rates much higher at all. You can have virtually zero interest rates on the back end of the bond market, redeemability in gold, but gold's got to go much higher. You're going to end up giving away all your gold. So could it happen? Maybe. Maybe that's part of the plan, but I don't see how you can suppress short-term rates and let long-term rates go higher. That's really where the problem is. It's less the short-term and more the long-term rates that I think they're worried about.